Okay, picture this. It is 2024. You walk into a conference room full of, serious institutional value investors.
Right, gray suits, spreadsheets everywhere.
Exactly. The air is dry, recycled, maybe a little stale. Everyone is looking for a safe harbor in a volatile market. And you, the optimist, you walk in and you tell them, hey, everyone, I have a stock tip.
Uh-oh. This never goes well.
There is this boring legacy hardware manufacturer. It makes memory chips.
Mm.
It is currently trapped inside a conglomerate that hasn't really gone anywhere in years. It's got debt, it's got baggage.
Okay, I'm already falling asleep.
But you say, if you buy it now, this thing is going to spin off, shed all that weight, and return nearly 1,500% in a single year.
They would have laughed you out of the room.
Laughed you out.
They probably would have called security to have you escorted out for being delusional. Seriously.
They absolutely would have. A 1,500% return. I mean, that is crypto number territory.
Meme stock stuff.
Penny stock mania during a bubble. That does not happen to legacy hardware companies that sell things you buy at Best Buy.
And yet.
But here we are. It is Monday, February 2, 2026. And the stock we are talking about is Sandisk Corporation, ticker symbol SNDK.
And it is sitting right now at $592.75 a share.
It has become the absolute poster child for what everyone is calling phase 2 of the AI revolution.
Right.
We spent the last few years obsessed with compute, the chips, the processors, the NVIDIAs of the world. But now the market has realized something massive.
Yeah.
You can have the fastest brain in the universe, but if it can't remember anything, it is useless.
We're moving from compute to storage.
Exactly.
That is the narrative driving this, yes. The market has shifted its gaze from the processor to the library. But the core question we need to answer today is a lot harder than just acknowledging the trend.
Okay.
Is this movement a symptom of a speculative mania? Is this just a greater fool bubble fueled by AI buzzwords where people are buying just because the chart is going up? Or is this actually a rational repricing of a business that has fundamentally transformed its entire economic engine?
That is exactly what we're going to figure out. Before we dive in, this analysis is brought to you by stockanalytics.ai. Get institutional-grade research on over 600 stocks for just $10 a month. Plus, request any ticker and download your own video analysis. Start your 7-day free trial at stockanalytics.ai. Now, let's get into it.
So, here is our mission for today. We are conducting a forensic audit of Sandisk. This is not just about the start price, it is about the machinery of the business.
And the timing is key.
Absolutely. We are doing this just 72 hours after their Q2 2026 earnings release, which was, frankly, seismic.
It was a monster report. I was reading through the transcript, and you could almost feel the shockwaves coming off the page.
It was. But here are the ground rules for this deep dive.
Good.
We are going to ignore the hype. We are going to ignore the giant green candles on the stock chart that make everyone feel that intense FOMO fear of missing out.
Right. No chart gazing.
We are going to look at the durability of their moat, their capital allocation, and this concept of the memory supercycle.
And I know you've been digging through the footnotes all weekend. You have a take on the valuation that might surprise people, especially given how much the stock has already run.
I do. The easy money has certainly been made. Let's be clear about that.
Right.
You don't get the first 1,500% again. That ticket has been punched. But when you look at the valuation metrics, oddly enough, the stock might actually still be cheap.
Cheap at nearly $600? That sounds counterintuitive. I mean, completely.
Potentially. But, and this is a massive bet that we need to circle in red ink, there is a huge black swan risk involving tariffs lurking in the background that nobody seems to be talking about enough.
Okay, let's unpack all of that. We have a lot of ground to cover. Part 1, chapters 1 to 3. Business, Management, and Financials. Chapter 1, Business Understanding.
All right, the main event.
So let's start with the event that everyone is talking about, the catalyst. January 29, 2026. Sandisk drops their Q2 earnings report. What exactly happened?
It was a paradigm shift. I mean, there's no other way to put it. The market was expecting good numbers. Everyone knew memory prices were rising. That wasn't a secret.
Right, the trend was positive.
But Sandisk delivered numbers that frankly look like a typo. Revenue came in at $3.03 billion.
Okay, $3 billion.
That is up 61% year over year.
61% growth for a hardware company is wild. I mean, that's just, you see that in software startups, not in companies that have to physically build things in giant, expensive factories.
It is, but the revenue wasn't even the main story, not by a long shot.
Oh, really?
Revenue is just the top line. The real shock, the earthquake, was profitability. Wall Street analysts, The people paid millions to model these companies and predict these numbers, had a consensus estimate for non-GAAP earnings per share EPS of about $3.49.
Okay, so they thought they'd make about $3.50 per share. A respectable number.
Correct. A very good number, in fact. Sandisk reported $6.20.
Whoa! Wait, say that again?
$6.20.
They nearly doubled the estimate.
They crushed it. They blew it out of the water. It's rare to see a beat of that magnitude in a large cap company.
Right, a beat is usually like a few pennies. 5 cents, 10 cents.
Exactly. This was dollars. But then, to add fuel to the fire, they gave guidance for the next quarter.
And it was good, I take it.
They're projecting EPS of $12 to $14.
Wait, hold on. Let me get the math right.
Go ahead.
So they just made $6.20, which was double what people thought, and now they're saying next quarter they're going to double that.
Exactly. They are essentially doubling profitability sequentially in a single quarter.
That's insane.
That is why the stock gapped up. That is why we are seeing this 13% move in the last session alone. The market is scrambling to re-rate the entire company because the earnings power is expanding faster than anyone anticipated. The models are broken, and the analysts are trying to fix them in real time.
Okay, so clearly they're selling something people want desperately.
Yeah.
But let's back up for a second. For the listener who maybe still thinks of Sandisk as the company that makes those little SD cards you put in your digital camera or the USB stick you lose in your drawer,
Yeah.
what is this business actually doing now?
It is a great question because the transformation has been profound. Remember, Sandisk used to be part of Western Digital, or WDC. They spun off in February 2025.
Right, the split. I remember that being announced and people sort of shrugging. It didn't seem like a big deal at the time.
And that split was critical. Western Digital was a conglomerate. They had the old school hard disk drive business, the spinning magnetic platters.
A lot of clunky ones.
Exactly. And they had the flash business. It was like trying to run a marathon while wearing a heavy backpack. The HDD business is in secular decline. It's old tech. It was dragging down the metrics of the shiny new flash business. By spinning off, Sandisk became a pure play.
So they cut the anchor loose.
Exactly. They are now solely focused on NAND flash non-volatile memory.
Okay, so NAND flash. Break that down for us.
It's the stuff that stores your data when the power is turned off. Unlike DRAM, which is the working memory that wipes clean when you reboot, NAND remembers. Your photos, your documents, your OS, it all lives on NAND.
Got it. But lots of companies make NAND. What makes Sandisk so special?
The real secret sauce here, the thing that gives Sandisk an edge, is their manufacturing model. They don't do it alone.
This is the partnership with Kioxia, right?
Right.
I always struggle to pronounce that. Kioxia.
Kioxia, yes. It's the former Toshiba memory business. They have a 25-year joint venture.
Okay.
Think of it like this. Imagine you want to live in a massive, ultra-luxury mansion, in this case, a semiconductor fabrication plant, or fab, but the mortgage is millions of dollars a year.
I'm listening.
If you try to pay that alone, you are house poor. You have no money left over for furniture or repairs.
Right, all your money goes to the building.
But if you have a roommate who splits the mortgage, the maintenance, and the renovation costs 50-50, suddenly you have way more free cash flow than your neighbor who lives alone.
That's a great analogy.
That is what Sandisk and Kioxia do. They split the capital expenditures, the CapEx, and the R&D for these massive fabrication plants.
And these fabs aren't cheap. We aren't talking about a warehouse.
No, these are the most complex buildings on Earth. A modern fab can cost $20 billion or more.
$20 billion.
By splitting the bill, Sandisk has a structural cost advantage over competitors who have to pay for everything themselves. And the scale is massive.
How massive?
Together, Sandisk and Kioxia produce roughly 1/3 of the global bits of flash memory.
1/3. That is enormous. That's basically an oligopoly position.
It is. In a commodity business, scale is everything. It allows them to amortize those fixed costs over a huge volume of units, driving the cost per unit down. It gives them pricing power and survival power that smaller players just don't have.
They have the structure right.
Yeah.
But where is all this new money coming from? You mentioned the AI connection earlier. Is it just people buying more USB drives for their AI art?
No, definitely not. It is coming from 3 streams, but one is doing the heavy lifting. You have the consumer stream, the SD cards and USB drives we talked about. That is growing about 39%, which is healthy.
That's the brand everyone knows.
Right. And the expert notes usually say that the Sandisk brand is like the Kleenex of storage. It has immense trust, providing a cash flow floor competitors don't have.
Sure, everyone knows the red logo. You see it at every airport kiosk.
Exactly. Then you have the Edge Stream Flash for laptops, smartphones, automotive. That is up 21%, also good. But then you have the data center stream,
And let me guess, that is the rocket ship.
up 64% year over year. And this is where we have to understand a concept called data gravity.
I love that term, data gravity. It sounds like physics. What does it actually mean in this context?
It basically means that AI models need massive data sets, and those data sets need to be hot. Think about milk versus cheese.
Okay, milk and cheese. I'm hungry, but go on.
Cold storage like old tax records is cheese. You put it in a cellar, a hard drive, and leave it there. You don't need it instantly. But AI data is milk. It needs to be fresh, instantly accessible, and poured into the model constantly.
Okay, I get it.
If you are training a large language model or running inference, you cannot wait for a mechanical hard drive to physically spin up a platter and find the data.
It's too slow.
Way too slow. It bottlenecks the expensive GPU you just spent a fortune on. You need enterprise SSDs, solid-state drives.
So the hard drives are getting kicked out of the data center.
For warm and hot storage, yes. They are being replaced by high-density NAND. And this brings us to Sandisk's technological moat. They aren't just selling generic chips, they are selling density.
This is the BiCS8 tech I saw in the notes.
Yes, BiCS8. It is their new 218-layer 3D NAND technology. Imagine a skyscraper. The more floors you can build on the same plot of land, the more rent you can collect. Sandisk is stacking memory cells 218 layers high.
And I saw something about Stargate, which sounds like a sci-fi movie, but I assume it is a product.
It is their new controller architecture. And sci-fi is appropriate because the capabilities are wild. The controller is the brain of the SSD. The NAND is the library, but the controller is the librarian who knows exactly where every book is.
Okay.
Stargate is optimized specifically for AI workloads. It allows them to build drives with 128 terabytes of capacity.
128 terabytes in a single drive. My laptop has like 1 terabyte.
Exactly. Imagine 128 of your laptops compressed into a single drive. Competitors were struggling to match that density. And why does that matter?
I was just about to ask.
Because in a data center, physical space is expensive. If you can store 128 TB in a slot that used to hold 16 TB, you are saving money on power, cooling, and real estate. Sandisk is helping the hyperscalers, Amazon, Microsoft, Google, solve a real estate problem.
That makes total sense. They aren't just selling storage, they're selling efficiency and density.
Yep.
Okay, so the business is firing on all cylinders. But a business is only as good as the people running it. Chapter 2, Management Evaluation.
The jockey, not just the horse.
Let's talk about the pilot flying this plane. David Goeckeler. He is the CEO, but he is not your typical chip guy, is he?
Yeah.
He didn't grow up in a clean room wearing a bunny suit.
No, and that is actually a strength. He didn't come up through the semiconductor fabs. He came from Cisco, the networking giant.
So he is an outsider.
In a sense. But he understands infrastructure, he understands the plumbing of the internet, and more importantly, he is a strategist.
Right.
Goeckeler was the architect of the spinoff. He was the one who looked at Western Digital and said, this conglomerate structure is destroying value. We are hiding the diamond inside the rock.
And his timing, I mean, pulling the trigger on the split in February 2025, right before this boom.
It is being described as a masterstroke. Think about it. He executed the separation right as the market was recovering.
Right.
If he had waited, they would have missed the start of the wave. If he had done it too early during the downturn, the new company might have been crushed by debt. Instead, Sandisk hit the ground running as a standalone company just as the AI demand wave started to crest.
I listened to the Q2 earnings call, and I was struck by his tone.
Oh, yeah.
You know, usually when a CEO has a quarter like this, they're doing a victory lap. They're using every buzzword in the book. They sound like they just won the Super Bowl. Goeckeler sounded almost bored.
Bored or perhaps disciplined. I had the same reaction. He was very direct, no promotional hyperbole. He focused heavily on profitability and fixed cost absorption. He didn't just shout AI and drop the mic.
Yeah.
He sounded like a man who knows that memory is a cyclical business and you shouldn't get too high on the highs.
I talked a lot about LTAs, right? Long-term agreements.
That is a critical strategy shift. Historically, the memory market is the Wild West.
Yeah, boom and bust.
It is transactional. You fight for every penny on the spot market day by day. It's incredibly volatile. Goeckeler's moving Sandisk toward long-term agreements with the hyperscalers. He is saying, look, you need this storage. Sign a contract for supply, lock in the price, and let's reduce the volatility.
That sounds like he's trying to tame the cycle. The memory cycle is notorious for booming and busting.
He is. He wants predictable cash flow, not a roller coaster. He wants to turn Sandisk into a utility rather than a casino.
That's a huge shift in thinking for this industry.
It is, and that connects to their capital allocation discipline. This is where the Buffett comparison starts to get interesting.
Yeah, let's look at how they spend their money. They have all this cash pouring in. Are they building new factories like crazy? Usually when chips are hot, companies dig holes in the ground to build more capacity.
Surprisingly, no. Their CapEx share was only about $216 million for the quarter.
That seems low.
It is. In the middle of a boom, they aren't recklessly breaking ground on new facilities. They are optimizing the existing ones, what they call node transitions. They are getting more bits out of the same factories by upgrading the machines rather than building new walls.
That shows restraint. What about shareholders? I noticed there is no dividend. Is that a red flag? Usually, mature hardware companies pay you to hold the stock.
Not at this stage. Warren Buffett actually prefers companies not to pay a dividend if they can reinvest that money at a high rate of return.
And they can.
Oh yeah, Sandisk is pouring money into R&D, into Stargate and buy CS8 to stay ahead of Samsung.
And what about buybacks? Usually when a stock runs up, management starts buying back shares to keep the momentum going.
And that is usually a terrible destruction of capital. Buying back your own stock after it has gone up 1,500% is rarely a good idea. You are buying high.
Right.
Sandisk reported no significant buybacks in Q2. Instead, they are using the cash to pay down debt.
Smart. Buying high is what retail traders do, not good CFOs.
Exactly. They are strengthening the balance sheet rather than trying to engineer the stock price. And when you look at the return on invested capital, ROIC, it validates this approach. We calculate it at around 41%.
41% ROIC. Explain what that means for the listener.
It is a compounding machine. It means for every dollar they invest back into the business, into a new machine or a new chip design, they are generating 41 cents of profit. As long as that number is that high, you don't want a dividend. You want them to keep that money and put it back to work. You'd rather they compound it at 41% than give it to you to put in a savings account at 5%.
Chapter 3. Financial health.
Okay. The foundation of the house.
Let's dig deeper into the numbers. We mentioned debt. You called it a fortress balance sheet in the pre-show notes. Why fortress?
Because it is virtually impenetrable. Compare this to the old Western digital days when they were loaded with debt from acquisitions. Sandisk has reduced their total debt to just $603 million.
That is barely anything for a company this size. It's pocket change.
It is, and they have $1.5 billion in cash sitting in the bank.
So they have more cash than debt.
By a lot. That means they have a positive net cash position of about $936 million.
So they could pay off all their debt tomorrow and still have nearly $1 billion left over.
Precisely. Their debt-to-equity ratio has dropped to 5.9%. This is another key Buffett attribute. It means they cannot go bankrupt in a downturn. When you are in a cyclical industry like memory, the thing that kills you is debt. If the market crashes and you owe billions, the banks come knocking and you're dead. Sandisk has removed that risk. They have the staying power to outlast anyone.
Okay, let's talk margins.
Yeah.
Because this was the part of the report where my jaw actually hit the floor.
This is the aha moment for the financial analysis. Their gross margin came in at 51.1% on a non-GAAP basis.
51%. For hardware, that is software territory. Apple would be jealous of those margins.
It is exceptional. But the context is what matters. A year ago, that number was 29.9%.
A year ago, so not that long.
12 months. They expanded their margins by over 2,100 basis points in 12 months.
How is that even possible? Did they just raise prices that much?
Pricing is part of it, yes.
Yeah.
Supply is tight, so they can charge more. But the real magic is operating leverage.
Okay.
Remember those high fixed costs we talked about? The fabs cost billions whether you run them or not. You have to keep the lights on and the clean rooms clean.
Right, the mortgage is due regardless.
Exactly. But once you sell enough chips to cover those fixed costs, every extra dollar of revenue is almost pure profit.
Oh, I see.
The cost to make the next chip is very low.
So once you break even, the rest is gravy.
Exactly. That is why a 61% jump in revenue caused earnings to quadruple. The costs stayed relatively flat, but the revenue soared over the top of them. That leverage is the secret to these massive earnings beats.
And that flows down to the cash flow.
It does. Their free cash flow margin is roughly 27.9%.
Which reads...
That means for every $100 of sales, they are putting nearly $28 of hard cash into the bank. They are converting sales to cash at an incredible rate.
Okay, so the business is great, the management is smart, the financials are rock solid, but the stock is $592. It is up 1,500%. This is too expensive. Are we buying at the top?
This is the twist. This is the part that's so interesting. Usually when a stock runs this hard, the valuation gets stretched. But if you look at the forward PE, the price, relative to the expected earnings for the next year, it is trading at about 11.8 times.
11.8, that sounds low in this market.
It is low. Historically, the S&P 500 trades around 20 times. NVIDIA trades at 30, 40, sometimes 50 times earnings. Palantir is even higher.
So,
Sandisk is putting up tech growth numbers, but it is trading at a commodity valuation.
so the market still thinks of it as a cyclical hardware company. They think this is a fluke.
Yes. The market is skeptical. It is saying this won't last. They are pricing it as if earnings are about to collapse.
But if they don't collapse,
But if the market decides to re-rate Sandisk as a compounder, even if the multiple just goes to 15x or 18x, the price goes much higher.
and you ran a DCF model, right? A discounted cash flow. What did that tell you?
Based on our educational model, assuming the supercycle holds for a bit, the fair value comes out somewhere between $680 and $750 per share.
So even after this run, the math says it could still be undervalued.
It suggests there's still room. But remember, that relies on the earnings staying this high.
Right.
If the cycle crashes, the math changes instantly.
And that is the cliffhanger. We're going to take a quick break. When we come back, we're going to look at who actually owns this stock, what the rest of the market is screaming, and that massive geopolitical risk we teased earlier. Like and subscribe to Stock Analytics AI. Want institutional-grade stock research without the institutional price tag? Check out stockanalytics.ai. For just $10 a month, you get full access to our deep dive video library covering over 600 S&P 500 and NASDAQ 100 stocks, each with full source citations you can verify. Can't find the stock you're looking for? Request analysis on ANY ticker and download your own video within 24 hours. Upgrade to Pro for $20 a month and unlock our SEC Risk Scanner, which detects red flags in company filings before they hit the headlines, plus our Portfolio Diversification Analyzer to optimize your holdings. Start your 7-day free trial today at stockanalytics.ai. Make smarter investment decisions with research you can trust. Part 2. Chapters 4 to 7. Market Sentiment, Ownership, Risk, and Final Conclusion. Chapter 4. Market Sentiment.
Okay, the psychology of the trade.
Welcome back. We have established that Sandisk is a powerhouse right now. But what is the mood on the street? Are people euphoric, scared? Is it rational?
It is a mix of panic and FOMO. Let's look at the analysts first.
Okay.
The big banks, Morgan Stanley and Jefferies, they are playing catch-up. They spent months with lower price targets. And now, after this earnings report, they are aggressively raising them.
They are chasing the bus.
They are sprinting after it, out of breath. The median target is now around $690, but we are seeing high targets as high as $1,000.
$1,000. That would be nearly double from here.
That is the Super Bowl case.
Yeah.
And the language they're using is telling. They are using phrases like extreme supply tightness and unprecedented demand. They are realizing that the supply chains simply cannot make these chips fast enough to satisfy the AI data centers.
And the media. I've seen the headline.
Oh, the media. The media narrative has shifted from ignored spinoff to, is Sandisk the next NVIDIA? That is a dangerous headline.
Oh, it sounds complimentary.
Because it drives retail FOMO. It sets a bar that is almost impossible to clear. High sentiment creates a very high standard. If Sandisk reports merely good numbers next quarter, say, they don't double earnings again, maybe they just grow them 20%.
Which would be amazing for any other company.
For anyone else, yes. But for them, the market might treat it as a failure because the expectations were set at miracle levels. It's the curse of high expectations.
That makes sense. That's like a band releasing a greatest hits album as their debut. The second album is always disappointing.
Perfect analogy.
What are the shorts? Is anyone betting against this?
Yeah.
Usually when a stock goes vertical, someone steps in to say, this is crazy.
Very few. The short interest ratio is low, about 0.73.
What does that tell us?
It tells us the smart money is not stepping in front of this freight train. The shorts have already been incinerated. If there were a lot of skeptics, you would see high short interest. But right now, nobody wants to bet against the AI storage trade. They know the demand is real.
But technically,
Yeah,
looking at the chart, it has gone straight up.
it has. It is extended well above its 50-day moving average, which is down at $424.
Okay.
Technically, it is overbought. That usually suggests we are due for some volatility or a pullback. Trees do not grow to the sky in a straight line. Investors should expect some red days, and that would actually be healthy for the stock.
Chapter 5. Ownership structure.
Who's holding the shares?
So who's actually holding the bag? Or, I guess, holding the gold in this case.
It is the heavy hitters. We are talking over 80% institutional ownership.
It is high.
It is very high. FMR LLC, that is Fidelity, owns nearly 15%. Vanguard has 12%. BlackRock has 6%.
So this isn't a meme stock owned by day traders on Reddit. This isn't GameStop.
No, this is owned by the pension funds and the asset managers. That is actually a stabilizing force.
I saw.
These guys aren't day trading. They are long-term holders. They provide a floor for the stock price because they aren't going to panic sell on a random Tuesday just because the market dips.
Yeah.
They understand the thesis.
But there's one interesting name on the list still. Western Digital.
Yes, the old parent company. They still own about 5.1% of Sandisk.
Why? I thought they split.
It is a legacy of the spin-off structure. They retain a stake, but here's the dynamic to watch. Western Digital needs cash for their own business, the hard disk drive business. They will likely sell those shares over time to fund their own operations.
So there's a big seller looming.
It creates a supply overhang. It means there is a guaranteed seller of millions of shares.
Well, that sounds bad.
It's not great, but honestly, with the volume, Sandisk is trading over 20 million shares a day. The market is absorbing that selling easily. It is a headwind, but a mild one. It's like a breeze against a Ferrari.
I also saw some insider selling. The CEO isn't dumping shares, is he? That's always a bad sign.
No, Gokulers is holding his core position.
Right.
We saw some Form 144 filings from directors and other execs selling, but let's be real. If your company's stock went up 15x, wouldn't you sell a little bit to buy a beach house or diversify your portfolio?
Absolutely. I'd be selling to pay off the mortgage.
Exactly. It looks like rational estate planning, not a lack of confidence. If the CEO started dumping everything he owned, I would be worried. But that is not what we are seeing.
Chapter 6. Risk Assessment.
All right, time to be the bear.
This is the part I have been waiting for. We have painted a very rosy picture. A perfect business, perfect margins, cheap stock. But you mentioned the black swan. Let's break down the risks. What could kill this rally?
Let's do a SWOT analysis, focusing on the threats. We have internal weakness and external threats.
Internal first.
The biggest internal weakness is that Sandisk sells a commodity.
Explain that.
NVIDIA has CU Day. That is software. Once you build on NVIDIA, you are locked in. It is hard to switch. Sandisk sells NAND. Yes, it is high-tech, but fundamentally, if Samsung makes a cheaper, better drive, the customers can switch.
There's no lock-in.
None. Amazon can unplug a Sandisk drive and plug in a Micron drive tomorrow. If supply exceeds demand, prices will crash. It is the law of physics in memory.
So they don't have that software mode.
Correct. And that leads to external threat 1, the cycle. We are at peak margins right now, 51%.
And peaks don't last forever.
Trees do not grow to the sky, as we said. Samsung and Micron are not sleeping. They are fixing their yield issues. They are building capacity.
It's an arms race.
It is. Eventually, likely by 2027, they will flood the market with supply. That is what always happens. The risk for an investor buying at $600 is that you are paying peak multiples on peak earnings right before the drop.
Okay, so that is the cyclical risk. But what is this geopolitical black swan?
This is the immediate danger, the Trump tariffs.
The ones announced in January 2025.
Yes. The chip war is escalating. Here is the nuance people miss. Sandisk makes its wafers in Japan. That is a friendly country. But the assembly and packaging, putting those tiny silicon chips into the black plastic cases to make the final SSD, often happens in China or Southeast Asia.
Ah, I see where this is going. It's the last mile of manufacturing.
Exactly. If the U.S. administration decides to apply a 60% or 100% tariff on SSDs assembled in China, Sandisk's cost structure breaks overnight.
They would have to raise prices massively.
Or eat the cost and destroy their margins. Either way, the earnings estimates we just talked about go out the window.
Can they move the assembly?
They can, and they are likely scrambling to qualify sites in tariff-safe zones like Malaysia or the Philippines. But that takes time. You can't just move a factory over the weekend. If a tariff hammer drops tomorrow, it would be a massive shock to the stock. It's a geopolitical landmine.
And what about the macro stuff? Interest rates, inflation.
Higher for longer interest rates hurt the startups that buy these drives. And inflation and energy costs in Japan hurts the manufacturing margins. But frankly, compared to the tariff risk and the cycle risk, those are minor. The tariff is the one that keeps me up at night.
Chapter 7. Conclusion.
So what's the bottom line?
Okay, we have looked at the good, the bad, and the ugly. Let's bring it all together. What is the verdict?
Let's synthesize the cases. The bull case is that Sandisk is a value compounder. It is the infrastructure play for AI storage. It has a cheap valuation at 12x forward earnings, a net cash balance sheet, and technological leadership with Stargate and BiCSA.
And the bear case.
The bear case is that it is a cyclical trap. The pricing power is temporary, the easy money is gone, and the tariff risks are existential.
So where do you land?
I land on Sandisk being a qualified value opportunity.
Qualified how?
It passes the Buffett tests. It has a moat, the JV scale. It has management we trust. It has incredible economics. However, the recovery trade, the easy ride from the bottom, is over. We are now in the growth phase, which is harder.
And the valuation.
Our intrinsic value range is $680 to $750.
So there's still upside.
That implies maybe 15% to 25% upside from here.
That is decent, but not 1,500%.
Exactly. So my advice, don't chase the green candles. Don't buy just because it went up yesterday. Look for pullbacks. If this stock dips toward $500 due to some market noise, that is where you build a position with a margin of safety.
Be patient. Wait for your pitch.
Exactly. Let the price come to you.
Before we wrap up, I want to leave the listener with one thought.
Go for it.
We focus so much on the AI brain, the processors, the logic. But think about yourself. What happens when your brain gets too big, too fast, but you can't remember anything?
You become dysfunctional.
Exactly. Sandisk is betting the farm that the future of AI isn't just about thinking faster, but about remembering more. And right now, they're the ones holding the keys to the library. If you enjoyed this deep dive, make sure to subscribe to Stock Analytics AI on your favorite platform.
And remember, this analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research.
Thanks for listening. We'll see you in the next deep dive.